Welcome back to the deep dive, where we really try to cut through the clutter on complex stuff, uh, building you that sort of personalized, almost institutional grade insight into finance and tech.
That's the goal.
And today, we're tackling something that, well, a lot of people see as the crypto world's holy grail. You
Yeah.
know, finding that real alpha through market efficiency.
Hmm.
We are doing a deep dive into crypto arbitrage, the strategies, the traps, and we're using the big one, Binance, as our main focus.
Yeah, and arbitrage, it sounds fancy, but at its heart, it's really about chasing market perfection, isn't it?
Right.
It's that sophisticated, super fast strategy of finding the exact same thing, same asset, priced differently in two places,
And grabbing that difference fast.
instantly capitalizing on that, well, that fleeting gap.
hmm
And focusing on Binance is key here. It's not just any exchange.
Why Binance specifically, though? It's just the biggest.
It's the volume, yeah, but it's also the deep liquidity, it's global reach.
Mhm.
All that makes it sort of the essential plumbing for actually doing arbitrage successfully, especially at scale, worldwide.
Okay, so the mission for us today is pretty critical. We're not just scratching the surface.
Surface level stuff here.
We really want to give you a genuine shortcut into how the big players operate, the institutional mechanics that really run this space.
We'll be looking at the different flavors of arbitrage.
Exactly. Unpacking those, four distinct types. Everything from the simple buy here, sell there plays,
Right, the cross-exchange stuff?
all the way to those complex internal loops that never even leave the platform.
Triangular.
But, and this is crucial, we really need to shine a light on the pitfalls, the execution traps, the tech hurdles, the sheer competition that means this is absolutely not just free money.
Definitely not free money.
Yeah.
Far from it. Now, before we dive headfirst into the nitty-gritty definitions, we actually have a quick note here from the source materials the listener sent over. It gives some context on, well, how this kind of analysis keeps going.
Ah, right. That logistical note. Yeah, the source package actually had this specific directive in it. It says verbatim. Before we dive deeper into Binance arbitrage strategies, make sure to like, subscribe, and hit that notification bell.
Right.
It helps this channel grow and allows us to keep breaking down the latest strategies, trends, and hidden opportunities in the crypto world.
And, just to add to that, engaging like the likes, the subscribes, it genuinely helps with visibility. It tells the algorithms this stuff is valuable.
Gates in the machine, basically.
Yeah, it helps these deep dives get seen, lets us keep digging into the cutting-edge strategies you actually want to hear about. That's part of how content creation works these days, really.
It absolutely supports the whole process. Okay, so logistics covered. Let's get into the core idea, starting with that fundamental definition of arbitrage and maybe digging a bit more into why Binance is such a cornerstone here.
Right. So fundamentally, arbitrage is it's trading based on something close to certainty.
Yeah,
And that's super rare,
Yeah.
especially in crypto markets.
extremely rare. Usually it's all about predicting the future.
Exactly. Here you're buying something where it's cheap and at the same instant selling it where it's expensive. It works because of market friction. These tiny temporary price differences for the exact same asset across different but, connected markets.
The classic analogy always clicks for me here. Imagine you see a specific high-end digital camera. It costs $1,000 at a big store in New York.
Okay.
But for some reason, just for a moment, it's listed at $1,050 on a big online site based in London.
Right. A clear gap.
If you could somehow instantly buy it in New York and sell it in London, boom, $50 profit, minus whatever it costs you to do it.
Costs are key.
You're just exploiting a temporary breakdown in how markets talk to each other.
And that's exactly what crypto arbitrage does. Just, way faster. At light speed, practically.
Yeah.
So why Binance again? It's more than just deep liquidity, isn't it?
Yeah, what does deep liquidity actually mean in practice for an arbitrager?
It means market depth. Binance can soak up huge orders. We're talking millions, sometimes tens of millions of dollars, without the price budging much.
Ah, so your own trade doesn't move the market against you before you're done.
Precisely. That stability is absolutely essential for the pros, the arbitragers, who need to trade big volumes to make those tiny, tiny percentage spreads actually worth the effort.
But there are structural things too, right? It's not just what's on the public order book screen.
Absolutely. The infrastructure matters.
Yeah.
Binance offers, well, really good API performance. They have dedicated tiers, special access for high-frequency trading firms.
Faster connections, lower latency.
Exactly. Combine that with a massive ecosystem, tons of trading pairs, global ways to get fiat money in and out, It means the serious traders can have capital ready to go in dozens of different currencies.
Pre-positioned.
Pre-positioned, yeah.
Hmm.
And they get access to ultra-low latency execution that you just wouldn't find on smaller, more regional exchanges. It's a built-in advantage baked right into the platform.
Okay, but let's think about the bigger picture. This activity, all this high-speed trading, it forces prices together, makes the market more efficient. That sounds good.
It is good, generally.
But isn't there a risk that Binance, by being the main place this happens, gets too much power? Does it distort the market by being the efficiency hub?
That's a really interesting point.
Mm-hmm.
It's definitely a complex trade-off. Arbitrage is, without doubt, a huge force for making markets more efficient globally.
How so?
Well, when a price difference pops up, you have all these arbitrageurs piling in, buying low, selling high. They were the mechanism that pulls the prices back together.
They close the gap.
They close the gap fast. Now, sure, Binance benefits because it's the central venue for a lot of that action, collecting fees and whatnot. But the entire market benefits from having prices that are more aligned and stable, less crazy volatility between exchanges.
So it's like a necessary function, maybe not glamorous, but it keeps things orderly and helps everyone get a fairer price.
Exactly right. And stable, reliable markets, they attract the bigger players. Institutional money, sophisticated trading bots, huge pools of capital, that reinforces the market's strength overall.
Okay.
And if you could do it right, arbitrage offers that unicorn in crypto, a low-risk profit strategy. It's about speed and infrastructure, not guessing market direction. It actually helps stabilize things, bringing more players into the crypto market globally.
Okay, this is where, for me, it gets really fascinating. We tend to talk about arbitrage like it's just one thing.
Yeah, it's not monolithic.
But the source material breaks it down. Professional traders, especially using a hub like Binance, they have this whole arsenal, at least 4 distinct strategies.
Right, let's unpack that arsenal.
Yeah.
We should probably start with the most foundational type, the one that involves moving things externally. Spot arbitrage.
Spot arbitrage. Okay, this feels like the closest to that camera analogy, right?
It is. Very direct.
You buy the actual asset, let's say Solana, SOL, where it's cheaper on Exchange A.
Like Coinbase or Kraken.
And then you immediately sell that SOL for a higher price on Binance. It's trading across different exchanges.
Simple concept. The killer is the execution speed between those platforms. As we mentioned, if you wait for the Solana blockchain to confirm your transfer from Exchange A to Binance,
The opportunity's long gone.
it's totally gone. Milliseconds matter. So the pros doing spot arb, they need capital ready on both ends.
Pre-positioned again.
Exactly. Like keeping a stash of US dollars on Coinbase and a stash of, say, USDT stablecoin on Binance. When the price gap appears, bang. Buy on Coinbase, sell on Binance simultaneously.
So you capture the price difference now, and then you sort out moving the actual SOL later to rebalance your accounts.
Precisely. You're not waiting on chain confirmations for the actual arb trade. It's about using those existing pools of capital instantly.
That sounds like a pretty complex operation just to track those price differences constantly.
Oh, it is. They're basically watching a live heat map of prices. Not just BTC on 2 exchanges, but dozens of pairs. SolUSD, ETH, BTC, whatever, across all the major global players. Binance, Coinbase, Kraken, maybe KuCoin, Bybit.
Like a dashboard of price gaps.
Exactly. And the sophisticated algorithms, the bots, they only pull the trigger when the gap is big enough to cover everything.
Everything, meaning?
Trading fees on both exchanges, any withdrawal fees later, estimated slippage, that price movement cost we talked about, and even the internal cost of tying up that capital.
Wow.
If the heat map flashes a gap that clears all those hurdles, say 0.4% after costs, that's the signal. Instant execution.
Okay, strategy 1, spot arb. Next up, cross-border arbitrage. This sounds different. Less about tiny tick glitches, more about geography, politics.
Exactly. This one exploits price differences that crop up regionally, often driven by things like national capital controls, maybe really high local demand in one country, or even significant tax differences between jurisdictions.
And Binance being global helps here.
Hugely. Because Binance operates, regulated or semi-regulated offshoots in many different countries, it becomes a potential hub for moving the value needed to bridge those regional price gaps. Maybe not always easy, but the infrastructure is often there.
This feels like it sets the stage for that famous kimchi premium example we need to talk about later.
It absolutely does. That's the classic case study. And the key thing here is these cross-border gaps can often last much longer than the tiny spot arb gaps.
Why?
Because the friction isn't just about tech latency. It's about regulations, banking laws, government policies. Those things are much harder and slower to overcome than just needing a faster internet connection. So these opportunities might stick around for hours, days, maybe even longer sometimes.
Right, regulatory friction is stickier than tech friction.
Okay, so spot and cross-border. Now we move into the really specialized stuff, right? Moving away from just buying and selling the actual coin, futures or perpetual arbitrage, the derivatives angle. Yep. This is where it gets more mathematical, more about financial engineering. It's a cornerstone for sophisticated traders, especially those running market-neutral strategies.
Market neutral meaning they don't care if Bitcoin goes up or down.
Precisely. They aim to profit regardless of market direction. In this case, they're capturing the basis. That's the spread, the difference between the spot price of an asset, let's use Ethereum this time, and the price of its derivative, like an each perpetual swap contract on Binance.
Okay, I know perpetual swaps are meant to track the spot price closely, but they don't always, right?
They don't always match perfectly. They deviate. Maybe because market sentiment is really bullish or bearish, or there's huge demand for leverage, or some big market event throws things off balance temporarily.
So if they're supposed to match spot, but they sometimes drift, how do traders find a reliable profit there? Seems risky.
They focus like a laser on one specific mechanism, the funding rate.
Ah, the funding rate. I hear about that all the time with perps. What is it exactly?
It's a small payment, happens periodically, usually every 8 hours on Binance, sometimes more frequent elsewhere. It's paid between traders holding long positions, betting the price goes up, and traders holding short positions, betting it goes down.
Why? What's the point of the payment?
It's the mechanism that pulls the perpetual contract price back towards the spot price. It acts like an anchor. If the perp price is higher than spot, longs pay shorts. If the perp is lower than spot, shorts pay longs.
Okay, so if the funding rate is really high and positive, that means longs are paying shorts a lot.
Exactly. And that tells you the perpetual contract is trading at a premium. It's more expensive than the actual spot price of Ethereum.
Uh-huh. So the arbitrage opportunity is...
The arbitrager jumps on that. They simultaneously do two things. They buy the cheaper spot, Ethereum, and they short the more expensive perpetual contract.
locking in that price difference, the basis.
Locked in. They are now market neutral. They don't care if ETH moons or dumps. They've captured the spread between spot and futures, plus they collect those regular funding rate payments from all the eager longs.
Wow, okay, so that funding rate becomes like a predictable income stream, almost like yield, on top of the price difference they locked in?
That's exactly how they see it. It offsets the risk of holding the position. It looks almost like a guaranteed yield generator, just based on math and market mechanics.
It sounds incredibly neat, almost too neat. If futures arb is so, like, mathematically sound and predictable, where's the catch? What can go wrong?
Basis risk. That is the absolute #1 danger.
Basis risk, meaning the basis, that gap between spot and futures, doesn't behave as expected.
Exactly. The whole strategy relies on that gap being stable, or ideally, shrinking predictably towards zero as the contract gets closer to expiry. No, perps don't expire. The funding rate does the job. But what if something crazy happened?
Like a flash crash. Or some huge regulatory news.
Right. A sudden, violent event could cause the perpetual contract to massively depeg from the spot price. The funding rate mechanism might get overwhelmed. If that happens, the arbitrager's leveraged short position on the perpetual could suddenly face huge losses, maybe even liquidation.
Even if their spot ETH position is okay.
Even if the spot position is fine or even slightly profitable on its own, the leveraged nature of futures means that basis risk can wipe you out fast if the market goes haywire in an unexpected way. It needs really careful management of your margin, your leverage levels. You need to be able to survive those extreme volatility spikes.
Okay, fascinating. Risk is always hiding somewhere. So that's 3 strategies. What's the 4th? The one that stays internal.
Triangular arbitrage. This is the self-contained loop, all happening inside Binance's own ecosystem,
Why is that appealing?
because it's often the fastest, lowest latency type. You completely eliminate the risk and the time delay of moving assets between different exchanges. No withdrawal fees, no waiting for block confirmations.
So what inefficiency is it exploiting then if everything's on Binance?
Tiny, fleeting mispricings between 3 different trading pairs on Binance itself.
How does that even happen? Shouldn't the math always work out?
Theoretically, yes, but in reality, sometimes the cross-rate calculation gets momentarily out of whack. If you trade asset A for B, then B for C, the implied price of A in terms of C should match the direct AC trading pair. But tiny delays in pricing feeds or momentary imbalances in liquidity on one specific pair can cause a brief divergence.
Okay, walk me through a concrete example, like the one in the source material.
Sure. Let's say you start with your base currency, maybe USDT, a stablecoin.
Okay, starting with USDT.
Step 1. You use your USDT to buy Bitcoin. You trade on the BTC-USDT pair.
Got it. Now I have a Bitcoin.
Step 2. Immediately, you take that Bitcoin and use it to buy Ethereum. You trade on the ETH BTC pair.
Okay, sold BTC, I got ETH.
Step 3. Finally, you instantly sell that Ethereum back into USDT. You trade on the ETH-USD pair.
And the goal is end up with more USDT than I started with.
That's the goal.
Yeah.
In theory, the price you effectively paid for ETH using BTC in steps 1 and 2 should perfectly match the direct ETH-USD price in step 3. But if there's that microsecond glitch, that tiny pricing difference.
The amount of USDT you get back in step 3 is slightly more than you started with in step 1.
Correct. And the source material gives that illustrative example. A super fast bot executing a successful loop might turn, say, $1,000 USDT into $1,010 USDT.
$10 on 1,000, that's
Yeah.
1%. Seems okay, but wait. The margins we talked about earlier for spot arb were like 0.4%. This seems better, but is it enough? A single withdrawal fee from an exchange can be more than $10 sometimes.
But remember, this is all internal to Binance. There are no withdrawal fees.
Yeah.
But you're right about the thin margins versus trading fees.
Yeah, how do traders make money on a $10 profit if they had to pay, say, 0.1% fee on each of those 3 trades? That's 0.3% in fees right there, eating up $3 of the $10 profit immediately.
This is exactly where being a high-volume institutional player on Binance makes all the difference. They aren't paying retail fees.
They get discount.
Massive discounts. They operate in the highest VIP tiers. Their trading fees might be down to fractions of a basis point, like 0.01% or even lower, especially if you're using BNB coin for fees. Way, way lower than the 0.1% retail user pays.
Okay, so their fee per trade is negligible.
Almost.
Yeah.
And they execute enormous volume. We're talking hundreds of millions, maybe billions in trading volume per month. That scale further reduces their effective fee rate.
Right.
So that $10 profit on a $1,000 loop only works if your total fees for the 3 trades are maybe less than $3, like you said. But for an institutional bot with ultra-low fees, running that loop potentially hundreds or thousands of times a day, deploying millions of dollars in capital each time.
That tiny $10 difference per loot suddenly adds up to very significant, very real aggregate profits.
Exactly. Scale and low fees are paramount for triangular arbitrage.
Okay, this is a good point to bring in some of those stories and case studies. Let's ground these strategies in reality, show how arbitrage has played out historically and how institutions use it today.
Absolutely. And we have to start with the legend, the classic example of regulatory arbitrage paying off big time, the kimchi premium.
The kimchi premium. Yeah, people still talk about this. It was this crazy period, wasn't it? Roughly 2017 through maybe early 2021.
Yeah, around that time frame, Bitcoin and sometimes other major cryptos too were just consistently trading way, way higher in South Korea than everywhere else.
Like how much higher?
At its peak, we're talking premiums, sometimes exceeding 30%, even 40% or more for brief periods. It was outrageous.
30%. So you could theoretically buy Bitcoin in the US and sell it in Korea for a 30% profit instantly. Why wasn't everyone doing that?
That's the catch. It wasn't a technical glitch keeping prices separate. It was a perfect storm of huge local demand in Korea, meeting very strict government rules.
Kind of rules.
Strict capital controls.
Yeah.
Making it really hard for foreign money to flow into Korea to buy crypto there, or for Koreans to easily send large amounts of crypto out to sell on international exchanges where it was cheaper. Plus, strong anti-money laundering regulations added friction.
So the arbitrageurs couldn't easily bridge the gap. The price difference just sat there because the regulatory walls were too high.
Precisely. The domestic price just kept inflating because the normal balancing force of arbitrage was blocked by law and banking restrictions. People who did manage to profit from it, they had to use incredibly complex methods.
Like what?
Finding obscure Korean banking partners, maybe exploiting loopholes in foreign exchange rules, sometimes using stablecoins or other assets as intermediaries to try and move value legally without hitting those capital control limits. The potential profit was huge, but the operational difficulty was immense. It's the absolute textbook example of how government policy itself can create a long-lasting arbitrage opportunity.
Amazing. Okay, fast forward to today. Arbitrage isn't about these huge, obvious gaps anymore, right? It's more institutionalized. Case study two, institutional arbitrage funds.
Right. These are the modern apex predators. They're not hunting 30% kimchi premiums. They're built to consistently capture those tiny spreads we talked about, maybe 0.05% up to 0.5% across the big liquid exchanges like Binance, Coinbase, Kraken.
They're going for consistency, low risk, steady returns.
Exactly. Low variance alpha. That's what their institutional investors want.
What gives them the edge? How do they consistently beat retail traders or even smaller, less equipped funds to these tiny, fleeting opportunities?
Pure infrastructure and speed. And a key part of that is co-location.
Co-location? That sounds serious. What does it mean?
It means they literally put their trading servers physically inside or right next door to the data centers run by the exchanges, like Binance.
Wow. Why? Just to have a shorter internet cable?
Essentially, yes. Yeah. It's all about minimizing latency, the time delay for data to travel. Even shaving off a fraction of a millisecond gives their orders a head start.
So if an arbitrage chance pops up,
Their co-located bot sees it fractions of a second sooner, sends the order faster, and it hits the Binance matching engine before anyone else's. They get the trade, the slower bots miss out or get a worse price. The gap closes before others can react.
it's a physical arms race for speed.
It absolutely is. Their whole game is about high frequency, high volume, capturing those tiny edges consistently over and over. That's how they deliver the predictable returns their investors expect.
Okay, so we see this intense focus on speed and efficiency in the centralized world on Binance. But you mentioned earlier there's a parallel in the decentralized world in Web3.
There is, and it's fascinating. It's known as minor extractable value, MEV strategies, primarily seen on blockchains like Ethereum.
MEV. Sounds kind of technical. How does it relate to arbitrage?
While the environment is different, you're dealing with block validators, transparent transaction pools called mempools. Instead of private exchange order books, the underlying goal is identical. It's DeFi arbitrage, and it's driven by speed and, crucially, controlling the order of transactions.
Okay, break that down. How does it work on, say, Ethereum?
So imagine a price difference appears between two decentralized exchanges, DEXs. Maybe ETH costs slightly less in Uniswap's ETHUSDC pool compared to SushiSwap's ETHUSDC pool.
Just like a spot arb opportunity, but between two DeFi protocols.
Exactly. An MEV trader, they're often called searchers, spots this gap. But they don't just send a simple buy on Uniswap, sell on SushiSwap transaction. That would likely fail or get front-run by someone else watching the mempool.
Front runs. Someone sees their transaction and jumps ahead of them.
Precisely, because the mempool is public. So what the searcher does is craft a special package called a bundle.
A bundle.
Yeah, it's a set of transactions designed to execute together, atomically meaning they all succeed or all fail as one unit. The bundle would contain: Step 1, the buy on cheap Uniswap. Step 2, the immediate sell on expensive SushiSwap. And Step 3, crucially, a payment, like a tip or bribe.
A bribe to who?
To the block builder or validator, the entity currently assembling the next block of transactions to add to the Ethereum chain.
Why bribe them?
To get priority placement. By paying the validator a premium, often through higher gas fees or direct off-chain payments, the searcher ensures their entire bundle gets included at the very beginning of the next block.
Ah, so they pay extra to guarantee their buy and sell executes before anyone else can react to the same price difference and before the market moves.
Exactly. It guarantees their arbitrage trade happens atomically and successfully before the inefficiency disappears. It's the decentralized world's equivalent of that high-frequency trading war we see on Binance, just played out with different tools, bundles, and validator payments instead of co-location and fast APIs.
That's wild. So whether centralized or decentralized, there's this constant high-speed battle to exploit tiny inefficiencies.
It dominates a huge amount of activity, especially in DeFi. MEV is a massive part of the ecosystem.
Okay, hearing all this, the kimchi premium profits, the institutional co-location, the MEV bundles, it almost sounds like if you have the tech and the capital, arbitrage is a sure thing.
It sounds like it.
But the sources hammer this point home. While it might be low risk in terms of predicting market direction, it's incredibly high risk when it comes to execution. This is the trap.
Absolutely. The number one execution challenge, hands down, is speed. We keep coming back to it because it's everything.
Those arbitrage windows.
So,
How short are we talking?
for modern spot arb, triangular arb, often just milliseconds, maybe 100 to 500 milliseconds. Half a second is generous sometimes.
Blink of an eye.
Literally. Which means any retail trader trying to click buttons manually, or even using a standard API connection from their home computer.
Has zero chance against the optimized machine.
Zero. You're competing against algorithms running on dedicated hardware, often co-located, designed purely for low latency execution. The competition is won or lost before a human can even process the information on their screen.
So it mandates a huge investment in tech.
Massive infrastructure spend, dedicated servers, Highly optimized code written in fast languages like C++, aired, resilient high-throughput API connections, even a tiny glitch. Your internet flickers.
Yeah.
The Exchange API has a brief hiccup. Market data feed lags by a second that can cause your trade to fail.
And you might pay fees even if the trade doesn't work.
Potentially, yes. Or you get only one leg of the trade filled, leaving you exposed. The technical barrier to entry is far higher than the intellectual challenge of just spotting the price difference.
Okay, speed is critical. Then there are the hidden costs you mentioned that can just devour those thin profits, fees and slippage.
Yeah, those margins are razor thin, right? Maybe 0.2%, 0.3% on a good spot arb trade.
So you need pinpoint accuracy on costs.
Absolutely essential. You need precise modeling. If a retail trader pays that standard 0.1% trading fee on Binance and the spread they see is 0.2%, well, half their profit has gone to fees right there. Net 0.1%.
And for triangular arb, you're doing 3 trades.
3 trades. So 0.1% times 3 could easily wipe out the entire theoretical profit before you even start. Arbitragers need to calculate not just the maker-taker trading fees.
But also potential withdrawal fees if they do need to move assets eventually.
And the big one, market slippage.
Okay, you mentioned slippage before. Break down the difference between expected slippage and the really dangerous kind.
Sure. Expected slippage is basically the predictable cost of making a big splash. If I need to buy $20 million worth of SOL right now on Binance, even with its deep liquidity, my own large order is likely going to push the price up slightly against me before it's fully filled.
Do you anticipate that and factor it in?
Right. I know it'll eat into my potential spread a bit, and I build that into my calculation. It's modeled. Unexpected slippage is the real killer.
What causes that?
It happens when the market suddenly moves more than expected while my order is executing. Could be network lag, a sudden burst of volatility hitting the market, or maybe a rival bot just beat me to the punch and started filling the order book right before my order landed.
So the price moves away from you instantly.
Instantly. And that unexpected jump can easily erase another 0.2%, 0.3%, 0.4% off your potential profit. Suddenly, after fees and unexpected slippage, you're looking at a loss on a trade that initially looked profitable.
Ouch. Which leads straight into the next major risk, the sheer intensity of the competition.
It's a shark tank. You're not just competing against other smart people. You're competing against highly optimized bots run by incredibly well-funded institutional players. It's effectively a technological arms race fought over milliseconds and basis points.
And these institutions have ways to protect their edge, right? Beyond just co-location.
Absolutely. They use other tools. For instance, they might utilize dark pools or, very commonly on Binance, the OTC, over-the-counter desks.
Wait, why use an OTC desk? Isn't the point of Binance its huge public order book liquidity?
It is, but sometimes executing a truly massive order on the public book is counterproductive, even with deep liquidity.
How so?
Because of that slippage risk we just discussed. Imagine an institution needs to buy, say, $100 million worth of Bitcoin quickly to set up one side of a big futures arbitrage trade.
Okay, huge amount.
If they dump that $100 million buy order onto the public BTC's USDT order book, it will move the price significantly against them before it fills. That's catastrophic slippage, potentially ruining the economics of their entire arbitrage play.
So the OTC desk lets them
Execute the trade privately, off the public books, directly with Binance or another large counterparty at a pre-agreed price. They get their $100 million Bitcoin without causing a ripple on the public market, without revealing their hand, and without incurring that massive slippage cost.
protecting their strategy and their profits, keeps them ahead of the smaller fish watching the public order book.
Exactly. It's another layer of institutional advantage that makes competing very, very difficult.
And then finally, circling back to the kimchi premium idea, there are still those real-world regulatory hurdles, the political and bureaucratic barriers.
Yeah, these haven't gone away entirely. They add significant friction and risk, especially for any strategy that does require moving assets across borders.
So even if you spot a great price difference,
You might run smack into practical problems. Severe capital controls imposed by a government. Really strict KYC checks required for local bank accounts needed to on-off-ramp fiat. Maybe just low daily limits on international wire transfers that physically prevent you from moving enough capital fast enough to make the arbitrage worthwhile.
the theoretical profit gets stuck behind red tape.
Pretty much. Bureaucratic friction can often be the biggest bottleneck, even when the technical opportunity looks perfect.
Okay, so we've really established this is a tough game, dominated by sophisticated bots and institutions with major advantages, which brings up a really important question. Aside from the traders slugging it out, what does all this arbitrage activity actually mean for the average crypto investor? the person just holding some Bitcoin or trying out DeFi, why should they care about this complex, high-speed stuff?
It actually matters quite a lot, even indirectly. It acts like the market's immune system, or maybe its plumbing system.
How so?
Well, first, just being aware of it helps. It demystifies price discovery for retail investors. Seeing these strategies shows them that prices aren't random. They're shaped by these active systematic forces trying to find equilibrium.
It makes the market seem less like magic and more like mechanics.
Exactly. It introduces them to real market concepts like funding rates, basis risk, slippage, things that deepen their overall understanding, even if they never trade arbitrage themselves.
Okay, raises awareness. What else?
Second, and this is more tangible, arbitrage directly benefits all users by making exchanges stronger and more stable.
How does that work?
All that capital rushing in constantly to close tiny price gaps. That adds liquidity and depth to exchanges like Binance.
So more buyers and sellers are always present.
Right, and better liquidity means tighter spreads. The difference between the best buy price and the best sell price is smaller. It also means better execution for everyone.
So even if I'm just buying $100 of some altcoin, I get a slightly better price and my trade fills more reliably because the arbitrageurs are keeping the market deep and efficient?
That's basically it. Without arbitrage activity, prices between exchanges would be more disconnected, spreads would be wider, and volatility would likely be higher. It's a stabilizing force.
And you mentioned the connection to decentralization earlier with MEV. How does CEX arbitrage influence that?
It lays the groundwork, technologically and conceptually. The relentless drive for efficiency in CEX arbitrage, building faster bots, better APIs, smarter algorithms, all that tech and knowledge gets transferred and adapted for DeFi.
The tools built for Binance get repurposed for Uniswap.
In a way, yes. The strategies might differ slightly, but the core challenge is the same. Find inefficiency, execute faster than competitors, manage risk. The need for market efficiency doesn't care if the market is a centralized order book or a decentralized blockchain. The systems balancing Binance today are effectively the ancestors of the systems trying to balance DeFi tomorrow.
So arbitrage isn't just about skimming profits. It's more like this fundamental force enforcing economic logic across this new digital landscape.
That's a really good way to put it. It's necessary, it's powerful, and it's constantly pushing crypto markets towards maturity and stability, even if it looks chaotic from the outside.
Okay, let's try and wrap this up. Pull the key threads together before we hit you with that final thought.
Sounds good. So the big picture, arbitrage is absolutely vital for a healthy, efficient crypto market. But, and it's a big but, the actual profit potential is heavily skewed towards those who can conquer the challenges of speed, infrastructure, and fees.
Manual trading, forget about it.
Completely outmatched.
We broke down the 4 main strategies you'll see, especially around a hub like Binance.
1. Spot arbitrage, the classic. Buy low, sell high across different exchanges, needing pre-positioned capital.
2. Cross-border arbitrage exploiting those regional price gaps caused by regulations, like the famous kimchi premium.
3. Futures perpetual arbitrage, more complex, capturing the basis spread and earning the funding rate, but watch out for basis risk.
And 4. Triangular arbitrage, that elegant, super-fast loop all within Binance, exploiting tiny cross-rate mispricings where ultra-low fees and scale are key.
And we saw how institutions make this work in the real world, using co-location for speed, OTC desk to handle huge volume without slippage, and navigating those tricky regulatory hurdles.
Yeah.
Plus, we connected it all to the DeFi world through MEV bundles.
Right. And the common thread through all the profitable strategies today is automation. Sophisticated bots are simply faster, more precise. They don't make emotional mistakes. They're essential.
You need them. Given how sensitive this is to fees, the complexity of managing risks like basis risk and needing that millisecond execution, programmed logic is really the only viable way to play the arbitrage game seriously.
Which leads us perfectly into our final provocative thought for you, the listener, to chew on after this deep dive.
Knowing everything we've just discussed, the dominance of bots, the speed required, the risks involved, but also the necessity of these automated systems, the question we want to leave you with is this.
Would you ever trust an arbitrage bot to trade your crypto?